Good afternoon, everyone. Welcome to this webinar. My name's Mike Hayes. I am a tax partner at Wilkinson Smith, and during the current crisis, we've been hosting a range of seminars to explain to clients and to contacts how the government in the UK has been introducing measures to assist businesses and to maintain employment levels. But today is an opportunity to learn about what is happening in the USA, as many of our clients have business interests in the USA, and they have subsidiary companies there, or maybe just employees based there. So we are hosting a seminar which is actually going to be given by Aprio. Aprio are an American firm of CPAs. They're the largest independent firm in the southeast of the USA. Their prime office is in Atlanta, Georgia, but they have other offices in that part of the world. And we're very pleased to have them present to us today. We have three speakers to address, and I'll hand over to those very shortly. The first one is Chris Williamson. He's a senior advisor in Aprio's transaction advisory group. Normally he focuses on private equity investments and domestic and international mergers. However, since the start of the pandemic, he's been spending a lot of time giving advice to clients on PPP, which is about paycheck protection. And you'll hear more from Chris in a minute. Carly Hubbard is a partner at Aprio. She's in fact a lawyer. She normally advises heavily on research and development credits that are available in the States, but today she's going to be talking about the Families First Coronavirus Response Act. And then finally we have Yelena Apova, who's a senior tax partner at Aprio. Yelena, apart from being a tax partner, is also the head of their international services department, and she's going to talk about some of the consequential impacts of the virus on corporate taxes in the US. So not direct measures, but some unexpected consequences. We would like to have, we will hand over to the speakers and they will follow one another, and we'll have a Q&A session at the end. I'd be very happy for you to pose questions. If you want to use the chat icon at the bottom of your screen and put your questions in writing, please feel free to do so. Either those questions will be stored up to the end of the meeting and answered verbally, or maybe one of the speakers will actually give a written response. So without any more ado, I'd like to hand over, if I can, to Chris Williamson, who will be talking about PPP funding.
Thanks, Mike. Can you hear me okay? I had a little bit of a connection issue a second ago and I lost my video as well. I just want to make sure you can hear me. All right.
Yeah, I can hear you.
Perfect, thanks. Well, thanks everyone. Thanks for having me here. Like Mike said, have been spending the past 8 weeks or more specifically diving into the Paycheck Protection Program for U.S.-based borrowers and subsidiaries of international companies, U.S.-based subsidiaries. And on the front end, we were helping clients understand the calculation for the PPP loans and how to apply. Whereas on the back end, we're really focusing on the forgiveness criteria and making sure, number one, clients are maintaining the appropriate documentation, but number two, they're understanding the guidance as it is ever changing and spending appropriately to make sure they're maximizing forgiveness and what's best for their specific business situation. So this first slide, just a very brief overview. What we'll touch on here again is how and kind of when and what period to spend the PPP funds, and then we'll go into a few of the factors on impacts to the forgiveness calculation. I do want to start off by saying this is certainly tailored for the U.S. based subsidiaries or borrowers that either expect to receive the PPP funding or have already received it. We have seen an update as of last Friday on the status of the program for those that are interested and have not yet received funding. And that update did indicate that there was about $120 billion left in the program that had not yet been utilized. So certainly applications do remain open as of the last update we've seen. And if you're interested and have not applied, that's something we can most definitely help with. But just to start off, the period of focus for the spending is an 8-week period. And that 8-week period starts on the day that the funds are received. And the key aspect of your spending over that 8-week period is these 4 allowable uses. These are the only items that you're actually allowed to spend the PPP loan proceeds on based on the certifications that were made in the application on the front end. And that's the payroll cost, rent, utilities, and interest. I have 2 bold items here that are very important. There's language in the CARES Act, the bill that has the Paycheck Protection Program within it, that states that each of these 4 buckets, in order to be considered for forgiveness during the 8-week period, have to be both incurred and paid. So we're not looking at this on a cash basis and also not on a true accrual basis. It's actually both incurred and paid. That's one of the trickiest items right now that we'll get into a little bit as we go along. And then lastly, an important item from a U.S. tax perspective is the expenses that are covered with forgiven funds are actually not tax deductible. And that was a new update as of about a week or 2 ago. That was really important. Ultimately, knowing that there's a potential increase in taxable income related to the use of these PPP proceeds. So to start off, before we dig into each of those buckets, I would say the question we're getting the most right now is what is the definition of economic uncertainty, which is what borrowers have to certify to on the application, and then how do borrowers define their need for this Paycheck Protection Program loan. And the reason we're getting this question is because the SBA and Treasury came out and said that they've extended the date to May 14th, the safe harbor date, that if you return the proceeds by May 14th, so if you received a loan and you return them by May 14th, they'll still consider you in good faith. And what they're saying is if you no longer feel like you have uncertainty and you don't think you're eligible, they're going to let you return the money and not be penalized. And the issue is they haven't provided any sort of clear guidance on what economic uncertainty means. And other than what we're seeing right here in quotes above, which is essentially saying, you have to consider your current activity and your access to sources of liquidity sufficient to support your ongoing operations. Now, what we're really doing with our clients here, number one, we're recommending certain situations to be considered with counsel. But number two, we're working with clients to help them with documentation. And that's documenting things, along the lines of building out the financial model that builds in specific scenarios of economic uncertainty faced from COVID-19. A few examples are looking at customer specific data and looking at collections and accounts receivable and documenting and writing a narrative around instances of impacts to your customer base, and whether those are backed up by cancellations or modifications of orders, delays in payments, extensions of your accounts receivable, an increase in write-offs or requests for specific extensions, and then also supply chain type of issues. Depending on what industry you fall in, we've certainly experienced a disruption in the supply chain across the world, and documenting those supply chain issues and how they can impact your specific business. And then lastly, really going through that access to capital and any sort of restrictions. So thinking through liquidity in terms of cash on the balance sheet, but then also access to certain forms of debt, whether fixed debt or variable debt, and understanding how impacts to your business can impact that access to that capital as well, and how that ultimately drives the uncertainty in the ongoing future. So it's not just focusing on today, it's focusing on uncertainty over the coming, months and potentially 1 to 2 years. So digging in a little bit more into each of the buckets of allowable uses. Payroll costs, pretty straightforward. It's the same calculation that was used on the front end. So if you've received the PPP loan, you'll just be looking at the exact same forms of payroll costs you use for your calculation. Similarly to the front end, there's a $100,000 cap per individual, and that equals $15,385. That's the max amount you can pay any individual and receive forgiveness for during the 8-week period. Utilities, this is the extent of the definition: electricity, gas, water, phone, internet, and transportation. There hasn't been any more detail provided. A little bit of a gray area. I think we've seen certain clients try and stretch some of the definitions. We do hope to see more guidance on this, but these are the buckets of utilities in the current guidance. Rent is a little bit tricky right now. So the only definition of rent that is available is rent obligated under a leasing agreement in force on or before February 15, 2020. The one challenge of rent is the CARES Act or the regulations released do not define whether it is specific to real property or both real and personal property. Meaning if you have a lease agreement on a piece of equipment, a copier, for example, or other personal property, does that qualify as rent? In the current guidance, we think the answer is yes. And we'll definitely look for any future guidance that's released. But right now, we're advising clients that it's broad-based rent under a leasing agreement. And that would also include related party rent, assuming that there is a leasing agreement in place and the rent is paid. Interest. The biggest kind of question on interest is that there's 2 buckets of interest. There's a bucket of interest that's forgivable, and then there's another bucket of interest that's allowable but actually not forgivable, which means you're allowed to spend the PPP funds on it, but you won't receive forgiveness for it. So the forgivable form of interest is actually only limited to mortgage interest. So non-mortgage interest is allowable but not forgivable. Some of the questions here, similar to rent, is the real or personal property question. For example, if you have a line of credit that's collateralized by real or personal property, does that qualify? And under the current guidelines, it's pretty specifically limited to mortgage interest only. And so we think that's a gray area. I don't know that I envision a line of credit, that's tied to a real or personal property as being considered in the bucket of a mortgage. So we're generally advising to take a conservative approach and expect that would not be forgivable. But we are also looking to, the guidance once they release additional guidance to see if that is clarified. But just important to note that there is 2 buckets here, mortgage and non-mortgage interest, and only mortgage interest is forgivable. So once you've gotten through your understanding of what you can spend the proceeds on, it's really important to understand, what are all the different ways that your forgiveness can ultimately be reduced. And what I want to say first before going into this is that the Treasury has indicated they will be releasing additional regulations on loan forgiveness. So as of now, we're working based on the information that's provided in the CARES Act and then the frequently asked questions document that the Treasury has released, but they have not yet released the regulations on loan forgiveness. So we do expect that some of these will be impacted. So I'm going to cover these at a higher level. We are following the current guidance as we work with our clients, but I'm not going to dig into the details too much here, given we do expect some changes to occur. So factor number 1 of forgiveness is to consider that you can only receive forgiveness up to the amount that you spend during the 8-week period. So for an example, if you were to receive $1 million loan, and in your 8-week period, the amount that is incurred and paid during that period is $900,000, well, you automatically, your max forgiveness now is dropped down to $900,000. So you lost $100,000 of forgiveness because you did not spend the full $1 million. The next couple factors ultimately can go in any order, but they're all going to be based on that factor one, meaning they're calculated off of what you spend, not necessarily off of the max loan amount. So I'll dig a little bit deeper into each of those. Factor number two is the FTE calculation. And what this factor does is it reduces your forgiveness if your FTEs, or full-time equivalent employees, is lower during the 8-week period when compared to the historical period. And how you do that is you look at your average full-time equivalent employees over the 8-week period. You compare it to one of these two choices. They actually give you a choice, February 15th, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. You're going to want to take the lower one because the average FTEs over the 8-week period is the numerator, or it's on top of the equation, and the bottom or denominator is on the bottom. Ultimately, you want your FTE average to be at or above your historical number. And so that's the reason for taking the lower of those two. So an example would be if you had an average of 9 FTEs during your 8-week period, and in your historical period, your average was 10. Well, then now you have 9 over 10, or 90% of forgiveness of the amount spent. Factor number one is your new max forgiveness. So taking it back to the last example, where you had $1 million loan and you received $900,000, or you spent $900,000, so your forgiveness was reduced to $900. Well, now if your FTE factor was 9 out of 10, you're actually going to lose another $90,000, or 10% of $900,000, given your max forgiveness is 90% of that $900,000. So now you're down to $810,000 of maximum forgiveness due to this factor reduction. Very quickly, they don't define what a FTE is. We're currently following the guidance as laid out in the Affordable Cares Act, which states that 30 hours or greater is equal to 1 FTE, and part-time is the number of hours divided by 30. So that's how we're calculating FTEs. Factor number 3 looks at payroll cost. And what this factor does is it says in bold right here, you cannot reduce anyone's payroll by greater than 25% without penalty. So any amount you reduce someone greater than 25%, your forgiveness will be penalized. So a quick example for that one, if you paid somebody $50,000, you can reduce them up to 25% of that, which would be $12,500. So if you reduce them by $15,000 all the way down to $35,000, you're going to lose forgiveness for that amount in excess of $12,500, or $2,500 will be the amount of the reduction in forgiveness based on that. Again, you have to consider the $100,000 cap here. You don't get credit for above $15,385. You can reduce someone who was in excess of $100,000 without penalty. I think that's very important. And then probably the most important aspect of factors number 2 and factor 3 is there's an exemption provision actually laid out that says if you eliminate those reductions that we said we were going to penalize you for, then we're going to not penalize you. And what it does is it says if those reductions in FTEs or reduction in wages in excess of 25%, if it occurred between February 15th, 2020 and April 26th, 2020, as long as you eliminate it, meaning you rehire the employees or you bring their wages back up to where they were before, as long as you do that by June 30th, 2020, they're not going to penalize you. And I think that's really important because a lot of our clients have cut headcount or cut pay, and maybe their business isn't reopened yet, and they don't want to bring them back today. Well, you have until June 30th to bring them back. The challenge here is if you don't bring them back by June 30th, you're going to have trouble spending all the proceeds. So we go back to factor number 1 and say that if you got $1 million, well, if you have half of your employees on the payroll for most of your 8-week period, you might only be able to spend a portion of that $1 million, which might be fine. And ultimately, the amount not spent and not forgiven would just become a 2-year loan, or would be ongoing as a 2-year loan at 1%. And certainly that can be a business decision that is made and that is most prudent for the business. One caveat they've pointed out here is that if you do offer to rehire an employee and they decline it, then you won't be penalized. So that's really important, given we've seen a lot of situations where offers go out and employees do not want to return to work. Reductions after June 30th, there's no guidance on this. We think after your 8-week period ends, that if your business is not yet rebounded, you've used your proceeds, that you likely are able to make the reductions if needed, if your position does not improve. They have not released any sort of guidance on that specifically. Factor number 4, what this one says is that you can only spend up to 25% of your proceeds, or of your amount spent, on those non-payroll related costs. So as we mentioned earlier, non-payroll related costs, that's rent, interest, and utilities. So of the amount you spend, if you spent that $900,000, only 25% of that $900,000 can relate to those non-payroll costs. Any amount you were to spend in excess of that, you can't have forgiven. I mentioned this earlier, but one really important thing I think a lot of people tend to overlook from the beginning of this is that there's a lot of focus on loan forgiveness, and we want to make sure our clients remember that ultimately this is debt once you receive it. On the day that you receive the PPP loan, it's a 2-year loan at a 1% interest rate. So you do have to make that business decision to understand you are taking on debt. And then most importantly, I think you want to make the best business decisions understanding that loan forgiveness might not be, maximum loan forgiveness might not be the best decision, meaning you might not want to bring back all of your employees immediately, because it might be more prudent to save some of the proceeds at a cheap interest rate to use after the 8-week period's up, when your business is actually rebounded or reopened. Important item to note there is that those allowable uses still apply even after the 8-week period. So once the 8 weeks is up, you can still only spend it on payroll costs, rent, utilities, and interest. You're not able to use it on any other items, given you certified to only use it on those items. So here's some recommendations. These next 2 slides will talk through some of the key recommendations and then how we're helping our clients as they work through PPP forgiveness. Number 1, set up a separate bank account. So the most important piece of PPP forgiveness is the documentation aspect. And in order to best document the flow of funds, the way we're seeing be the most beneficial, and this combines with the second bullet, is to treat it as more of a reimbursement methodology. So have the PPP funds in a separate bank account, and then at the point of a payroll cycle or when rent or utilities are due, is to transfer those funds into your operating account to reimburse the exact amount that is due. And the important thing here is documenting that exact amount and how you're determining the amount the PPP funds are covering. Because think for payroll, for example, there's certain aspects of your payroll cycle that aren't covered by PPP. The employer's share of Social Security and Medicare in the U.S., those are not PPP eligible funds. Those payroll provider fees, if your payroll provider charges you a fee each payroll period, that's not an allowable and forgivable PPP use. And so treating this reimbursement methodology will allow you to only reimburse or pay using PPP funds for the amounts that are actually allowable and forgivable. And we think that's very important. The third bullet, consider converting to a weekly payroll cycle. Now, this is certainly not necessary, but I'll tell you why it might help. I said earlier on, there's language that looks at your expenditures have to be both incurred and paid during the 8-week period. And to give an example of this is, what if your payroll cycle is twice a month or every other week, and the payroll cycle at the beginning of the 8-week period straddles across your start date? For example, 1 week of the payroll was the week before your start date, the second week was the week after, and then you pay it at the end of that second week. Well, then under the incurred and paid language, you're only going to get credit for the 1 week that fell after the 8 weeks and not the full amount paid. And then if you look at the back end of your 8-week period, you might have a similar situation where only 1 week falls in the 8-week period and 1 week falls out. But the pay of it, when you pay the payroll actually after the 8 weeks is up, well, you won't get credit for it because it was not incurred and paid during the 8-week period. So converting to a weekly payroll cycle might be important. Another way to handle this might be a stub period at the end of the 8-week period, or paying, a mid-cycle payroll to capture those open days at the end of the payroll period. This next bullet, reports from payroll providers. We do expect that payroll providers will be providing certain reports on the back end of this to help with the application process. Reports that show you your average FTEs and help you understand the total amount spent on payroll during the 8-week period. We are working with some of the payroll providers that our clients use, and we understand they're working on this, but at this point, none of them have rolled anything out. But we do expect there will be assistance from the payroll providers on that end. I'm not going to cover the next bullet too much because Carly is going to cover that in the next section, but you can take advantage of payroll tax deferrals along with PPP, but I'll let Carly cover that in the next section. And then lastly, we're recommending all of our clients to utilize their 13-week cash flow forecast to project their spending over the 8-week period. The important thing here, as I mentioned earlier, is to make sure you're not only focusing on loan forgiveness, but you're focusing on all the cash inflows and outflows of your business to understand whether or not it makes the most sense to use all of the PPP proceeds during the 8 weeks, or to only use a portion of it and to save some of it for periods down the road after the 8-week period ends. So what are we doing to help with our clients? We've developed and created a PPP forgiveness consulting team. There's about 30 people on our team. And really the items we're focusing on is number one right now, of course, up until May 14th, is how to document the need requirement, or how to document that economic uncertainty. So working with clients through a form of a checklist to understand how they can build the narrative around their economic uncertainty and ultimately how to best document that. The second part is analyzing allowable expenditures under the PPP loan. So it's guiding our clients to make sure they're only spending the proceeds on those allowable expenditures. And then also focusing on that incurred and paid language. So making sure the timing of those expenditures is in line with the guidelines. Similar, providing recommendations for how to account for the spend. And that goes along with the separate bank account. Not only separating your bank account and tracking the flow of the funds, but also separating your general ledger and creating new accounts that are specific to the PPP expenses that are incurred. That'll be really important on the back end as well, given that the expenses that are related to forgiven funds are not tax deductible. So really being able to break out what you spend and where those fall in your general ledger to help you on the back process. Sorry, I think I just lost sound for a second. I hope I didn't go out for too long. But jumping back in on the recommendations for the general ledger, that's just the best approach for tracking the spend of the expenses as you monitor and maintain that reimbursement methodology. Develop strategies for allocating funds to boost your balance sheet. That's really working with your 13-week cash flow forecast and working with your spending across the 8 weeks and beyond the 8-week period, to make sure you're working most beneficially for your balance sheet and cash flow. Allocation and timing of spending. Again, I mentioned that in bullet number 2. It's the allocation across those 4 buckets, making sure you're spending the right amounts on payroll versus non-payroll costs, and achieving that maximum forgiveness based on those reduction provisions we talked about. And then documentation. Of course, there's an application on the back end, so documentation becomes extremely important when you submit the application on the back end after your 8-week period has ended. The last two bullets, assisting in preparation of 13-week cash flows. If you don't maintain one of these on an ongoing basis or have not started to during the pandemic, certainly something we're helping our clients with in terms of building that out. And then tax planning strategies. I'm going to defer a little bit to Carly on that one because she'll touch on some of the credits, but the eligible expenditures are not tax deductible. And that's a really important factor when you're considering things like R&D credits or considering some of the factors that Carly is going to get into. So again, I really appreciate Mike and team allowing me to be on here to talk through this. If anyone's interested, feel free to contact us through this aprio.com/forgiveness page. We are helping our clients through each of these items, and it's certainly a case-by-case basis. And how I'll end it is just to say that we are expecting additional guidance on loan forgiveness. We know there's a lot of uncertainty out there right now on how to apply this, and our clients have received the funds and are looking for guidance on how to spend it. So we are guiding and consulting based on the latest guidelines and regulations released, and then we're adapting and planning to continue to adapt as quickly as possible as new guidance is released. And I think that's the most important thing to monitor here, is knowing that what is out there today might be different than what is out there tomorrow. So I'm going to go ahead and pass it off to Carly. Mike did a brief introduction in the beginning. Carly is the partner in charge of our R&D tax credit practice, working a lot with both U.S.-based and international R&D opportunities. And so Carly's going to talk a little bit more about the Families First Coronavirus Response Act and CARES Act and the related tax incentives and credits that were provided as part of those two bills. So Carly, I'll go ahead and pass it over to you.
Chris, thank you so much for the introduction, and thank you for all of that very interesting content that you provided. I know that's probably first and foremost on most of our clients' minds right now. So I'm going to start off talking about the paid sick leave and the paid family leave credits. These are the first credits that came out as a part of the family, or as a part of the Coronavirus Response Act. And so, really these credits, and I'm going to go through these quickly, but you should have access to the content later. These credits are very specific, and they're not going to apply most of the time. So the other thing about these initial two credits is that they're very intertwined with HR policies. And there are some employment law concerns or unemployment law concerns with these credits. So we would say if you do have anyone that might apply for those, we always highly recommend that you touch base with your HR, head HR, and then also an attorney. And if you need a recommendation for that, we're happy to recommend some attorneys there. So essentially, the required paid sick leave to qualify, you have to have fewer than 500 employees. And there are some special exemptions for companies who have fewer than 50 employees, meaning that you don't have to offer them certain benefits that you would typically otherwise in the States. And then there's specific qualifying reasons for this sick leave. So really the sick leave is for people who are either have sought out diagnosis due to COVID and are unable to work as a result, or for people who are in quarantine orders and unable to go to work. These companies are allowed to take tax credits. And you can also take advantage of this credit if you're taking care of a sick relative, so a family member or child under the age of 18. And so the credits are a little bit different for both whether you yourself are sick or whether you're taking care of someone who's sick. The credits are up to 80 hours, so 10 business days of sick paid leave. And the credits are paid out at the employee's regular rate, but only up to $511 for self-employed folks, or 2/3 of your daily rate, up to $200 when you're taking care of a family member. So the credits are lower if your employee is taking care of a sick family member versus if they're sick themselves. And the credit does have caps, you'll see here. Self-employed individuals can take this credit. And there's new guidance here that's really crucial to remember, is that If your employees, have had COVID-19 and they did not seek diagnosis or medical treatment, they didn't go to a healthcare provider, call a teledoc, something like that, and have proof that they had that they did seek treatment, then you won't be able to claim this credit for them. So, and this is where things get a little tricky, because obviously, there are HIPAA healthcare violations, HIPAA protections where, people's healthcare documentation is secure and private. So this is where the lawyers kind of come into play. You want to make sure that you're advising your employees accurately. And I'll show a summary of this later so you can see how these credits interplay. And then there's also a Paid Family Leave Act as a part of the initial act that came out. And again, it's for employees who have, or companies who have fewer than 500 employees, and that they do have to have worked for the employer for 30 days or more. And in this situation, it's really just to take care of family. And so we know that in this situation, a lot of folks, a lot of us are all kind of working from home with our children, but there are some jobs that you're unable to actually, take care of your kids and also go to work. And so in a situation like that, when you're having to take care of your children, you don't have childcare options, there are credits for companies whose employees are in that situation as well. And this is kind of a summary of what those credits are. And so this is kind of a good example of how they all kind of interplay, and what sort of the total, there's kind of a cap on that credit per employee. And the cap is for the entire year. And so typically, this is probably the first quarter that we'll really see people taking advantage of these credits in the United States. And I will say, most payroll companies are really doing a good job of handling these credits. But obviously, we would be very happy we actually have a mechanism to track these and help you calculate them, and also can liaise with your attorneys to ensure that all of the HR components are being handled as well. So the credit that we see more people actually qualifying for is the employee retention tax credit. And this credit is a fully refundable tax credit. It's for employers, and it's for folks who are in a very specific set of circumstances. So the business operations are either fully or partially suspended during any calendar quarter due to COVID-19. And so when we're looking at this, when you think about, well, what does that really mean? So obviously, if your company can't open up at all, so a restaurant would be a great example. If you're partially suspended, that might be, there might be a situation where you have a company where a segment of your workforce can't do their work remotely. So, a great example is an accounting firm. Most of us can do our work remotely, but there's a segment of the support folks that actually can't. They're not able to do their work remotely. They're handling the paperwork, filings of returns, and things like that. And if you have a partial suspension of your work related to sort of a quarantine or a shelter-in-place order put in by COVID-19, you could qualify for credits. And then you can also qualify for credits if in any quarter during the year for 2020, you have a 50% reduction or more in gross receipts for any quarter. And then once you hit that 50% as compared to 2019, so that's how they're comparing it. If you hit that threshold, then you can continue to claim the credit each quarter until you hit over 80% of what the gross receipts were for that quarter in 2019. And so they're kind of trying to give you a boost to get back to where your gross receipts were in the prior year. And again, we haven't really seen this credit come into play much yet because we think that we're really seeing the impact more in Q2 than we did in Q1. And so, the credit is really limited up to $5,000 per employee, and that is the cap for the entire year. And it's up to 50% of qualified employer wages that are capped at $10,000. And the interesting thing about this credit is that it's for companies of all sizes, so a lot more people will be able to qualify for this. These credits are all going to be reported on your Form 941, which is your payroll tax return, and they're applied against Medicare and Tier 1 taxes. Now, the interesting thing is these credits are actually refundable. The ERC credits are. So the IRS has developed a mechanism where early in the quarter, if you know you're going to be qualifying for this credit based on your financials, you can actually ask for a more immediate refund instead of waiting for it on the 941, which is fantastic. Something really important to mention, and I think Chris probably mentioned this also, is that if you did get the PPP loan as a part of the CARES Act, then you're not eligible to take this specific tax credit. And so from a tax planning standpoint, Chris, you can jump in if I'm wrong, but I think we would typically say, gosh, getting a forgivable loan is probably more valuable than getting these tax credits on a dollar for dollar basis. But that is something that we could help you analyze for your particular company. But it is something to keep in mind that if you do end up getting approved for a PPP loan and you were wanting to take this credit, that then you can no longer claim the ERC credit. And these credits also, as Chris and Mike mentioned, I run our R&D tax credit practice here at Aprio, and these credits are reported on the payroll form. There are some specific situations in the U.S. where you can use your R&D credit against payroll withholding, and these credits are typically going to be ordered after the R&D credit, so you'll just have a bit of a delay in when you can use your credits. And we'll see that all play out at the end of Q2 when we start filing these forms for our clients. So the payroll tax deferral is another interesting thing. So the IRS is allowing folks to defer payroll taxes through the end of the year. So if you're in a situation where you need to improve your cash flow, you can go ahead and just defer payroll taxes through the end of the year, and then you have through the end of 2021 to pay back 50% of them, and then through the end of 2022 to pay back the other 50%. So you have essentially 2 years to pay them back. So it's not a loan, but it is a way to kind of infuse cash and give the economy some time to rebound, as we all hope that it does soon. So something to keep in mind about this, again, there's a bit of an ordering scheme with the tax credits that interplay. So your deferral might be, if you have tax credits, those will be used first, and then the deferral will kind of come after that. And it is reported on your Form 941, but it's very easy to do. I mean, all you really need to do with this is just call your payroll company and ask them to start deferring your payroll taxes, and they'll start handling it for you. And then you kind of do have to work out your payback mechanism of how you're going to do that next year and the following year. And there's some details on which specific taxes make up payroll taxes, and those are all listed here. And again, this is sort of some of what I already mentioned. So we'll skip that. That's great. The only other thing to mention with this, and again, Chris, feel free to jump in if I'm misstating anything, but there is an interplay with the PPP loans and the payroll deferral. And so guidance has come out that basically has said this is different than the employee retention credit. So with the employee retention credits, you should not take them if you're taking the PPP loan. If you're planning on being forgiven. If with the payroll tax deferral, you can go ahead and continue to defer your payroll taxes until your loan is forgiven. And so the great thing about this is that the forgiveness might not happen until November, right? So you have a good portion of the year where you can go ahead and continue to take the payroll tax deferral. And then once your loan is forgiven, then you can go ahead and you want to stop that immediately, stop the deferral immediately, and then just take advantage of the forgivable component of the loan. So that's kind of how they interplay. And again, I know that was a very high-level overview of the credits, and just to kind of reiterate, as Chris mentioned, a lot of people might not be able to get these PPP loans, and so there are other mechanisms from a tax planning standpoint that can help you save money, that can help kind of put money back in your pocket more immediately than you would typically see. Most credits are usually filed on a tax return the following year, so the government's trying to give us ways to get cash back in everyone's pockets sooner than that. And then, another thing that I mentioned, because it is my specialty area, is that obviously research and development tax credits, and there are a lot of other tax credits and incentives in municipalities in the United States and different states that allow people to reduce their taxable income. And some of our clients have been having us do estimates early so that they have reduced quarterly payments with their estimates. And so that's something that we've seen people utilizing as a tax planning mechanism also. Again, happy to answer any questions you guys have coming through in the chat at the end of this. And now I will hand it over to Yelena Ipova, who is one of the smartest women that I know. She is the partner in charge of our international tax practice. And, her book of business is really, spans the globe. And her creative tax planning for our clients is really second to none. And so definitely utilize her as a resource in the Q&A to ask specific questions about your companies.
Can you hear me now? Hey.
Hear you now, yes. Yelena, we can't hear you. It might help to switch off the video.
I think it looks like she might have dropped and be rejoining. I don't see her name on the attendee list right now. It just disappeared. So we might want to give her just a minute to rejoin.
Well, I'm sorry, I'm back. I got kicked out for a second. Maybe I'm the smartest person in international tax, but technology somehow is not kind to me today. Can you hear me okay now?
We can hear you. Sounds great.
Okay, perfect. Thank you so much. And thank you, Carly, for a very nice introduction. And I appreciate everybody listening. My part is not maybe as sexy as loan forgiveness and tax deferral, payroll tax credits, and but it's something that should be considered in the current environment, and to minimize the risk, but also to minimize any negative tax implications on global companies. So first, I will cover a little bit on transfer pricing, and as you can imagine now with travel restrictions and also lack of sometimes supply chain being disturbed and lack of resources, you may have a large disparity in business in different countries. I'll give an example. It's not a UK company in this particular case. I have a client that is in Argentina, and they make ventilators. Obviously very much in demand product nowadays, unfortunately. And Argentina now imposed restrictions on shipping out any parts to assemble this ventilators outside of Argentina because they want to make sure they have enough for themselves. So their business is booming and booming in their home country, but the US sub basically sold everything they had, have no spare parts anymore, and now completely on standstill, waiting for Argentina to reopen its shipments. So in that particular case, and there are many companies in a similar situation. This company was considered what we call limited risk distributor in the US. So based on that, they had to maintain a certain level of profits in the US, and those profits are not necessarily controlled by volume of transactions. So you have your fixed costs, and then if your sales went down significantly, how can you maintain that level of profit? That will not really represent the true picture of your business model. So in those cases, you have to look at the policies and potentially change your methods, or look at the functions also that are performed in different countries, and see where the risk is now. And it's definitely because of, like I said, because of travel restrictions, or because of just the change of the whole business, the situation may change where your profits are actually generated. And in those cases, you don't want to end up with the income in the US and maybe loss in your home country. You have to review the policy and make changes. Sometimes it's advisable to consider what in the normal environment would be called profit split method. In this case, could be loss split method. But at least changing, your method or your policy will help you sort of equalize what's going on in respective countries and not pay big tax in the US and be in a loss position in the UK, or vice versa. When you do make changes to the policy, though, do remember that we will recover, hopefully sooner than later, and you cannot continue changing your policy on a daily basis. So think about what can potentially happen, like when you do recover, and if you will have to continue using the same policy going forward. So just it's a case by case basis. Some companies may be just fine. Probably most technology companies that are not necessarily labor intensive should be able to keep their method intact, but companies that depend on travel, also depend on shipments, tangible goods, supply chain, those companies definitely have to make a revision. Next slide, please. So another topic that I would like to cover, and it again has to do mostly with travel restrictions and its impact on nexus and permanent establishment issues, and I will explain further. So what, can you go back one slide? I'm sorry, Sean. No, I think, that may be in a different order. Yeah, this is fine. No, actually, I'm sorry, one back, because they have them in different order, I guess. Just go back one. Further. Maybe okay, this is the one, sorry about that. So travel restrictions and obviously closed business sites may cause directors and employees to perform services in unintended jurisdictions. And I would like to walk you through some risks and considerations and also some practical steps here. So what are the risks? Let's say your directors A cannot travel to where the meeting should be, or they may be actually, your directors or employees may be stuck, not being able to come back from a business trip they were on when travel restrictions started. So the risks obviously include residency for your company. Let's say you have a director in the US, and that director is a director for both the US and the UK company. There is very likely that your US subsidiary may actually have its own physical presence in the UK. So you may end up with the UK parent with the presence in the UK, and then US South potentially having presence in the UK, which is not the best result. Substance requirements. Let's say you have a company, maybe a middle company or some sort of company in Ireland, or Jersey, or somewhere else, and those places, they require substantiation of business activities in order to keep those companies alive, and to take advantage of the beneficial tax rates. And let's say you cannot travel there, you cannot substantiate, you cannot provide enough substance in those countries. What happens there? What happens then? Place of business and permanent establishments. Again, let's say you have employees, maybe they were traveling to the US for a week or two, and they got stuck here. And by being here, and their physical presence here, and also by their responsibilities, they may end up creating nexus, a permanent establishment. That's a treaty term for your UK company in the US, without your intention to actually to have this happen. US state tax nexus rules also very important and different from the federal rules. You may have somebody, let's say you have a company with a presence in Georgia, but you have an employee who went to California from the UK and got stuck in California and has been in California for a while. Depending on your business in California and what this employee is doing and the responsibilities, you may end up having nexus in California, which is not the best state to have nexus in. They're aggressive, they're expensive. So that's something to consider as well. Sourcing and apportionment, as you know or don't know, US states, they tax based on different factors, and how income could be sourced to different states based on that particular state's rules. So you may end up, again, in my example, California, you may have an employee there. They may, if you're actually doing business there, if you have any sales there, you may end up paying much more tax there if you have a person there being there for extended period of time. And then, of course, individual tax residency. US has very unique rules when it comes to residency and taxation of residents on worldwide income. And again, somebody who is here may unintentionally become US tax resident. And it's not not 1 year test. Sometimes people think that it's 183 days in a particular year, but it's actually a 3-year test where you have to go back to 2 years back, take all the days you spent in the US 2 years ago, divided by 6, go 1 year back, take all the days you spent in the US that year, divided by 3, and then take all the days in 2020, and then add those 3 numbers. If those 3 numbers are 183 days or more, you're a resident. And of course, you can, if you're a UK resident at the same time, we have a treaty, we can potentially apply what's called tiebreak rules. So there are solutions for that, but it's something to be aware of. If this happens, there are filing requirements. Even if you're able to claim non-residency based on the treaty, being dual resident in 2 countries, you do have to file US returns to claim that position. So a lot of things to consider, and we're hoping there will be some sort of break, some sort of relief in the US issued for circumstances like this, or also relief issued in places like where a lot of companies have their board of directors meetings, things like that, but we haven't seen anything yet. And obviously there are many more important issues to consider now in this current COVID-19 crisis situation, but this is something that is also super important to remember. Next slide, please. The previous then. I'm sorry, Sean, go back to the previous, yeah, one more, this is it. So just some practical steps if you do have the situations that I described happening to your company. You have to look at your policies, first of all, your policies for your directors' meetings, what's required, how often they're required, where do they take place, and make sure you understand your baseline risk, because some of the policies to begin with could be risky, right? So you definitely don't want to add more risk to them. Consider temporary amendment to these policies, and perhaps having online meetings, Zoom meetings, Fuse meetings as we're having now, and consider that for quite some time, even when restrictions are lifted, there is a potential that none of your directors or employees would want to travel for quite some time. So those policies could be amended for, post-crisis situation. Consider delay also. I mean, if your meetings don't have to take place at certain intervals, perhaps you can wait and see sort of scenario. Alternatives, if if certain decisions have to be made in a particular country, and you have to maintain substance there, like I mentioned, Ireland, Jersey, some other places. Consider hiring independent contractors, lawyers, consultants to act on your behalf, and also very, very important that if you need these people to sign contracts on behalf of the company, they need to be independent, so you don't create additional presence in additional country. Document everything as much as you can, because I'm sure that there will be some rules and regulations coming from different countries, and that will explain what happens in this particular situation. So document your policy, document what you're doing to comply, so you have information available for the relief that will be hopefully coming soon. And like I said, consider whether you want to have measures adopted, kept in place for after this crisis, in case it comes back, or in case it lingers for quite some time. So these are just some things that I would recommend doing. Again, safety obviously comes first, and definitely we wouldn't recommend making your people travel when the travel becomes allowed, but actually take a look at your policies and see how you can adapt operating in a virtual environment. I think this is it for me. So thank you very much. I don't know, Mike, if we see any questions.
Okay, thank you, Elena. Yeah, okay, Elena, thank you very much. We left a little bit of time at the end for some questions. There don't appear to be any ones on this group chat. So does anyone have any questions they would like to raise at all?
Mike, I think I see one from David Tucker, it looks like. There's a question, I think this is directed at Yelena. I can go ahead and read it. It says,
all right,
one second. It says, I have a financial services company in London and Bermuda. I am a resident in Bermuda for tax. We're currently exploring opening an office in the U.S. now next year. I'm currently stuck in the U.S., unable to return home to Bermuda due to COVID-19. What are my tax implications now and in the future in the U.S.? I'm concerned about the significant presence test this year and what the implications this might have on my days allowed in the U.S. and if I then become a tax resident next year.
Yeah. Thank you for the question. So my understanding that that you're a resident of Bermuda, which is not the best situation for this particular fact pattern, because we don't have a treaty with Bermuda. If for UK residents, maybe not so crucial, because we have a treaty. We can take a treaty position for dual residents, but for Bermuda, no treaty. So if you end up having tax residency based on how I explained that, based on 3-year test, you will become a U.S. resident most likely, although there are two things that may be working in your advantage. A, we're hoping there will be some rules and regulations for situations like yours, because again, it's unintended stay here, obviously. And if you can, I would definitely ask you to document everything. I'm sure you probably had your train tickets, and document the intent of your trip and the length of your trip that was going to be intended versus what it looks like now. The hope is that there will be some clarifications coming from the IRS. But if there is no clarification, there's another potential solution. They have what's called closer connection exception. But again, that very often depends on number of days spent here. So if none of this, if all of this fails, then your situation is, you will become a resident in 2020, basically from the time you entered the US, not, sometime later in the year, but from the first day you were here. And that means taxation based on worldwide income, which could be very undesirable in many cases. And also US is a very curious country. So in addition to taxation of worldwide income, there's a lot of reporting on foreign bank accounts, interest in foreign-owned companies, and things like that. But we can talk offline about this. I just reach out to me, and we can talk through your specific fact pattern and see what can be done or what we can plan for. But the fact that you are non-treaty country resident may make it more difficult.
Okay, thank you, Yelena. We've got a couple more questions, which I think are directed at Chris. Can you see them, Chris?
I can see them, yes.
Would you like to pick those up? Before you answer, there was one question: is will we be sharing the presentation to those who've logged in? And the answer is, of course, we will. But that will happen later. Over to you, Chris.
All right, thanks. So on the PPP loan, what happens if your loan is $100,000 and your payroll cost in 8 weeks is only $60,000? Will your max forgiveness then be limited, or will you not qualify for any forgiveness? So a couple different factors to consider here. So if your loan amount is $100,000, I just want to talk through how that was calculated. So $100,000 was calculated as 2.5 times your monthly average payroll cost in the historical. Sorry, I think I just lost sound. Can you guys hear me now?
We can hear you now, yes.
So the loan amount is calculated based on 2.5 times your average monthly payroll cost. The reason that's important is because 2.5 times is 2.5 months, and 8 weeks is 75% of 2.5 months. And so as long as you're spending in line with your historical practices, then your 8 weeks will be 75% or greater than that 2.5 months, and will get you to that metric. So in the event that you're worried about not hitting 75%, I guess what that tells me is that either your pay has been reduced, meaning you're paying people less than you did in historical periods, or it would tell me that your FTE count has been reduced. You have less people that you're paying. And I think that brings in the other factors that we discussed earlier, that you want to make sure you're capturing those factors. If your spend is down, meaning you don't hit 75%, because your pay or FTEs are down, and you ultimately bring them back and get the exemption before June 30th, well, that's fine. The 75% is 75% of forgiveness, or of the amount you spend. It's not of the full loan amount. So you don't have to spend 75% of the whole loan amount in order to get any forgiveness. It's all based on how much you spend. So you certainly can get forgiveness that is less than the full amount of the loan. And then, Mike, when I got my sound cut off, I now lost the other questions. Can you read me what the second question was?
Second question is, when do you believe the forgiveness rules will be out? This is key for planning. We need clarity before we can make key decisions.
Got it. I wish I had a really good answer for this one. The only thing I can tell you is that the CARES Act stated loan forgiveness regulations would be released 30 days after the CARES Act was signed into law, which was March 27th. 30 days from then was April 26th. It's May 12th now, and we have not seen any regulations on loan forgiveness. So I would have, 2 weeks ago, I would have told you we certainly would have had it by now, but sitting here today, I think I've lost hope, and I'm just deferring until we see him. I don't know the answer to that one, unfortunately. I agree. Many people are 4+ weeks into their 8-week period and need the guidance. So I certainly hope that it comes soon.
Okay. Does anyone have any more questions? It would appear that the answer to that is probably no. So perhaps it's time to bring this webinar to a close. So without any more ado, can I just please thank Elaine, Carly and Chris for their interesting presentation. As I said, we will distribute that to those who are on the call and those that couldn't make the call. And there are contact details on there if you need to follow up with anyone at any time. So thank you to our speakers, and also thank you to our participants for attending. Thank you very much.